Options promises higher returns, but also carries higher risk. And when you're just starting out, those risks can seem intimidating. This video will give you a clear blueprint for the specific skills, research, and mindset shifts you need to make to become a better options trader. This is the 5 levels of options mastery. Level 1 is the aspiring trader. If you don't learn how trading works, you're gonna lose money to those who actually have learned. All the metrics, the P&L, the options chain, you don't even know what you're supposed to know. So you outsource your thinking to other people, you give in to hype, to FOMO, anecdotal advice, passed off as actual research, you go to Reddit or YouTube. You hear packaged phrases like, cut your losers short, let your winners run, or taking a full loss is always bad, or always trade with a positive risk reward, or always hedge. Now, I've been teaching people how to trade for years, and these are the phrases they carry with them. And it seems like reasonable advice in theory, but once you know the underlying mechanics, you'll see why these can be oversimplifications and sometimes outright wrong. Let's look at the advice that you should always trade with a positive risk reward. If your risk is how much you could lose on the trade if it goes against you, and your reward is how much you could gain, then your winners should be bigger than your losers, right? Well, let's say you have a trading strategy that works 40% of the time. And when it works, you make on average $500, and when it doesn't work, you lose on average $250. With those numbers, you're in the positive, so it works. But let's change things up a little. Let's say you have another strategy with average winnings of $130 and an average loss of $350. Now that's pretty steep, but what if the win rate is 91%? Now across 100 trades, that strategy with a negative risk reward is actually more profitable significantly than the positive risk reward. So as you can see, always trade with a positive risk reward just isn't always right. Now, when I learned to trade, I realized that a lot of advice is just too simple to actually be useful. They're like 2-dimensional models of a 3-dimensional world. I mean, let's just be honest. Options trading is very complicated, and you won't really understand it if you just absorb a bunch of general advice and packaged quips. If you want to know how the system works, you can't just guess the direction of a stock, buy an option, and hope you hit it big. You have to actually understand the process, the why and how certain trades lose and others make money. And it's not just about whether a stock goes up or down. You should understand real trade structures like spreads and how they fundamentally change the outcome of a trade. This is a critical step that no one wants to tell you about because it sounds complicated or risky. And this is the problem with a lot of trading content. They're focused on the outcomes of trades without really telling you how to get better at trading. That's why we're making this YouTube channel. We're not influencers, we're a team of financial and investing experts, and we've been trading and teaching others how to trade for decades. We believe you don't need years of investing experience to have financial literacy or security. And here are the following steps that will help you change your understanding from what is happening to why and how is this happening. First, and I'm not coddling you, but you need to open a paper trading account. This lets you simulate trades using real market data without losing any of your money. Now, the key here is not to practice actually making money. I'll cover that later. Instead, I want you to just practice executing trade structures. Here's the first one. Find out on your paper account where you can buy and sell an option at the same time. You want to use the same type of option, so calls or puts, and you want to use the same expiration date. Let's start with what I personally use the most, a debit spread. To do this, you will buy a more expensive option and sell a less expensive option at the same time. This creates a leftover cost. For example, if you buy a $4 call and at the same time you sell a $3 call, you are buying that combination for a debit, which just means a cost of $1. And that's why we call it a debit spread. The goal of a debit spread is that the price of the stock expires in the money. That means above the strike prices of the options. For example, if I bought a $230 call option on Apple and I sold a $235 call option on Apple for March 20th, then I would need the stock price of Apple to be above $235 on March 20th. If that happens, I win. When you open this trade, instead of focusing on the premium or the number in your account, I want you to actually focus on these 3 things instead. First, look at the 2 strike prices you selected in the order ticket. Subtract the lower price from the higher price. This is going to tell you the maximum possible value of the spread. So again, that Apple example would mean subtracting the $230 value from the $235 value, which means the spread width is, of course, $5. Second, look at the order confirmation where it says net debit. This tells you the total risk of the trade. In the Apple example, let's say that's $2.50. Finally, find the difference between the spread width and the price you paid. Now that number tells you your maximum possible reward, or the most you could make if the trade works out in your favor. Your max reward for this Apple case is $5 minus $2.50, which is $2.50. or $250 per contract because every options contract value is multiplied by 100. This is where so many traders, even experienced professional traders, actually mess up. They think their risk is $5 because they only look at the spread width and ignore the actual values. They miscalculate their risk to reward, which will ruin all of your other calculations if the risk to reward is off. Now, it's not that they don't know how to calculate $5 minus $2.50. It's that a common misconception is that the risk of a spread is always the width of a spread, which is just flat out wrong. This is just another example of how novice traders fixate on the outcomes, not the process. So don't be like them. Learn the mechanics, spread width, credit versus debit, and how to define the risk to reward ratio. Now, one video can't give you everything you need to know, but I'm including a free PDF with no email or sign up needed that covers the basic terms and concepts you'll need to know at this level. But remember, these can only get you so far. All of the experts at our channel, myself included, we didn't get better because we memorized a couple vocab words. We practiced how these trade structures work in real markets. Once you understand the mechanics, you're far ahead of most traders, no matter what short-term outcomes they're bragging about, because in the long run, the market rewards in-depth understanding. Level 2 is the judgment jumper. Once you get the hang of the underlying mechanics of trading, you're still gonna doubt your judgment and risk giving up all the progress you just made. And this is another mistake beginners make. They confuse their judgment with their outcomes. Now, it typically goes like this. You calculate your risk correctly, you understand the mechanics of the trade, but the outcome is completely different from what you predicted. You'll think you made the wrong decision. So you look back at your very short track record and think, well, I guess I did something wrong because I just lost money. Or maybe think, I need to get the perspective of someone who's more experienced. Then you fall into that same negative cycle in the first level. You outsource your judgment to others, they give you oversimplified advice, and guess what? You lose more trades. The problem isn't that you're making the wrong decisions. The real issue is that you don't know how to evaluate your own decision making. With something as complex as option trading, framing trades in binary right or wrong is way too simplistic when there are far too many variables for you to hold at once. If you won, you could have gotten lucky. If you lose, maybe you're just on the wrong end of the right odds, and you made the right decision with limited information that you had. You can't grow and learn if every new piece of information can trigger you to completely change course. The thing is, overcoming this problem is easy. All you have to do is reframe your prediction as relative odds. Instead of thinking, I think the price will go up, think, I'm 70% confident the price will go up. You're using a rough number to quantify how confident you are in a prediction. Let's look at that Apple debit spread as an example. Once you look at the stock's current price, the volatility, maybe the probability of it staying above 235 in your mind, you can say, hey, I'm confident there's a 70% chance of success on this trade. Then, over time, you can actually determine if your analysis is right. Do you actually win about 70% of the time that you think you have a 70% probability? Do you win 50% of the time when you think you have a 50% probability? Seeing how close you are to your analysis will help you refine your assessments. And note that no matter how confident you are, some losses are expected. Now, let me make a clear distinction. Trading isn't betting. Betting, when it comes to gambling, is entirely focused on outcomes and chance. A probabilistic mindset, on the other hand, is centered on evaluating your decisions and quantifying your judgment. The thing you're betting on isn't the outcome. You're actually betting on your judgment of predicting outcomes. And that's an important difference. Trading always has uncertainty, but probabilistic thinking lets you sit with that uncertainty and ask yourself questions about your own judgment and psychology. The more you trade and the more you refine your probabilities, the better you'll get at evaluating your own decision making. Here's the first step you can do to build that probabilistic mindset. Execute a simple spread and frame it as odds. I think there's an X% chance that it's going to go up to Y dollars over Z days. Write that in a journal or trading log and don't change it. This is important. Don't think about probabilities in terms of expected value or the delta of the option right now. That's probability based on the outcome. We're actually evaluating how we assign probabilities to our judgment, okay, which is process. Instead of looking at the spread or the stock price, focus on the changes happening to the following variables: implied volatility, time decay, volume, open interest. As you check these variables at the end of each day, ask yourself, did these changes increase or decrease my confidence in my original trade? If they did, write down what you think the new percentage chance is, but don't get rid of your original answer. You'll need that later. When the trade expires, Look at the final price. Was your analysis correct? Look at the list of percentages you jotted down as the trade progressed. Did you get less or more confident in your original bet the more things changed? Did that stream of new information change your confidence that much? The answers to these questions help you see how new information affects your judgment. If you had huge changes in your confidence, but your guess was correct, well, then you're susceptible to recency bias. This means you're going to overestimate the importance of new information. If your confidence didn't change, but your prediction was wrong, that means you're vulnerable to confirmation bias, where you only process information that supports your pre-established beliefs. Instead of just labeling the trade as a win or a loss, evaluating your probabilities helps you actually see how well your judgment tracked these evolving conditions. But before you do all this, there's one catch. Don't do this on a paper account. Paper accounts are like training wheels. Once you're at a high enough level, they only hold you back. Sure, they can be useful for learning how to do basic functions, but paper accounts have time delays and unrealistic field mechanics. Simulated markets have infinite liquidity, which means trades can seem more successful than they would be in real life. They also give beginners a sense of false confidence. So when someone starts to trade with real money, they get destroyed right out of the gate. Let's avoid that. If you want to understand the psychology of trading, you need to use real money. The proper mindset needs real stakes. Now, facing real risk and fear builds the resilience for real trading. But I'm not giving you permission to bet the farm, not at all. Start with a small sum of money. Enough that's unpleasant to lose, but not so much that it's going to devastate you. Go back to your trade and write down the emotions you feel before, during, and after you execute the trade. Observe these emotions from a distance. Do those emotions affect your probabilities? Do they make you change your approach? Does fear make you pull out of the trade quicker? Does FOMO make you stay in the trade too long? The answers to those questions reveal your trading psychology, and your psychology is one of the few variables you actually can control. Now, you can take that probabilistic mindset, combine it with emotional awareness, and then you can get a positive feedback loop. Creating probabilities gives you a way to keep emotions from affecting those rational decisions. Observing and naming emotions helps you understand what skews your probabilities. With structure and repetition, calm and measured execution will become second nature to you. A strong mindset doesn't eliminate all the risk of trading, but it does help you avoid the biggest one, impulse. So developing a probabilistic mindset lets you think like a trader. Now, to act like one, you need to give yourself rules. Level 3 is no rules, no tools. At this level, some of the biggest obstacles traders face are position sizing errors. They see a trade they like, and then based on pure emotional bias, they decide how much they're gonna risk. Now, you can see why this is bad, right? They end up over-risking on the trades they like instead of having consistent risk across the board. Position sizing errors destroy consistency. They wipe out your gains, and you lose the mechanics and mindset you've been building for the past 2 levels. To prevent these errors, you have to give yourself rules before you trade. You have to apply them, revise them, and treat them like a life raft. What kind of rules? Well, give yourself repeatable instructions that help you stick to the actual levels of risk and sizing criteria that you want to maintain, no matter what the market tells you. The best trading strategies need rules that guarantee consistency. Some of these rules include your max risk or how much you're willing to lose on one trade. Now, if you decide that you're never going to risk more than 2% of your account in each trade, and you have $10,000, then you know your max risk per trade is $200. Once you have your max risk, you can find your position sizing criteria. And this helps you find out how many contracts you're going to take on any given trade. So if you take an option that costs $60 per contract, then you know, hey, I can take 3 contracts without exceeding $200 of total risk. Now, this is the most important rule. You need to have a cutoff. When things don't go your way, what's going to save you from overtrading, chasing losses, and emotionally spiraling are those cutoffs. So establish beforehand the following. You already know the maximum loss that you're going to accept on a single trade, but that's only one-dimensional. You also need to know your max drawdown before you need to take a pause and recalibrate. Are you comfortable taking a 10% drawdown on your account in pursuit of aggressive gains, or maybe 25%? If you know you are willing to lose 25% as a max drawdown ahead of time, then losing 3 trades in a row and having a 6% drawdown shouldn't break you. Once you have that decided, you can focus on the real trade mechanic rules, establishing your entry and exit rules that dictate when you open and close a position. Remember, we're dealing with probabilities, not gut feelings, so it's important to define your entry in terms of data and probabilities. For example, let's say your entry rule is this. You enter a long debit spread if a stock on your watch list makes a new 52-week high because the data shows it has a 70+% chance of going higher in the next 4 weeks. But you can only enter the trade if the spread is priced the right way, a step most people completely skip. You know the trade idea, but can you execute the trade itself? Here's a rule you could use. If the debit spread cost is more than half the width of the spread, you shouldn't take it. If it's less than half, you can take it. Now that guarantees your risk reward will be in line for the kind of probability you're trading. That's the kind of rules you want. For your exit rule, make sure you know exactly how you plan to manage trades ahead of time. You never want to make a decision about an open position by staring at a chart. For example, decide if you're going to always take profits when the trade meets 75% of the max value. Then set that as a target ahead of time. You could also decide to close it if it gets below a certain value, but I almost never recommend that. To put this all into practice, write them in a real trading plan, noting down all of the precise rules. The max loss you're willing to risk, your position sizing, your cutoffs, and your entry-exit triggers based on hard data. Next, go back to the emotions you jotted down. Explain to yourself how each of these rules prevents those emotions from interfering with your judgment. Next, do some simple trades with those rules in place. After 10 or 15 trades, look at the data. Ask yourself, did my rules protect me from further losses? Did they cut off too early? With enough trades and enough data, you'll know if, why, and how you should have adjusted your rules. This is how you learn and grow safely. Each trade is one measured step towards success. So in the short term, rules give you a life raft. But after months and even years of trading, you're going to encounter market conditions you've never seen before. You're going to need a bigger boat. Level 4 is the fragile forecaster. So you understand the underlying mechanics of the market. You have that probabilistic mindset and you have a rules-based strategy. That's great, but they won't make you immune to the chaos of the market. Policy changes, bubbles, geopolitical conflicts, any kind of unexpected shift is going to challenge every lesson you learn. Anyone can build a winning strategy in ideal conditions, but if you don't develop the resilience to handle short-term setbacks, if and when the market crashes, so will you. You want to know the biggest mistake traders actually make at this level? They get stuck in a short-term perspective. That's what ideal conditions can do. They narrow your perspective until you only think about the here and now. A short-term strategy over a long enough time will feel unreliable when you inevitably reach a bad turn in the market. Short-term thinking is the final pitfall before you become a proficient trader. And it's why so many traders end up abandoning everything their experience has shown them. When it feels like your strategy isn't working and everything is falling around you, you need to step back and take a long-term perspective. Look at the past and to the future, not the present. Sure, in bad conditions, reducing risk and tightening cutoffs might feel like a good adjustment, but you have to know this. Half of a good long-term plan is knowing when to change, but the other half is knowing when not to change. How do you know whether to change or not? Take a step back and look at your short-term strategy across a month-to-month perspective. First, establish a review cycle. Don't look at your tracker after every win or loss. Remember, we're looking at process, not outcomes. After 20 or 30 trades using your short-term strategy, compare your net expectancy to the average profit or loss across those trades. You're also going to create a long-term hedge to protect against worst-case scenarios. Dedicate a small portion of your portfolio, say 10% or less, to profit when your main strategy loses money. This hedge is your insurance policy that stops you from tossing out your entire strategy when the market is too volatile. And finally, you're going to define an adaptation rule. This means if your strategy hits negative expectancy across 3 or more review cycles, only then can you revise it. That way, your strategy can expand and iterate itself over a long enough time window without you worrying how short-term fluctuations question everything you built. If you hold on to that long-term perspective, you'll find exactly what you were looking for at the beginning of your journey, what I promised at the beginning of this video. Consistency and clarity. And that's going to lead you to level 5, the proficient trader. And once you're here, you're focused on compounding profits and minor optimizations to get better and better. Now, obviously, everything you need to know about options can't be condensed to a single video. Trust me, mastering options is an ongoing process. But this is a firm foundation that you can build on. And if you ever get overwhelmed by how much you need to learn and know about options, just come back here and remind yourself of the process. So I hope this lesson was helpful. If it was, click subscribe. We have a lot more videos coming out for you, and we want to help as many people as possible.